What will happen to China if the US pulls out all of its investments? Several US companies have invested in China. Some of the world's leading and most prominent brand names have established their operations in China. The companies have put up manufacturing and distribution facilities in major cities in China. The US companies are attracted to China because of a fast-growing economy, a huge population, 1.4 billion people, and a steadily rising middle class. It is worth noting that due to its rapid development, China has one of the fastest-growing middle classes in the world. It is known that the middle class is a highly consumptive segment of the population owing to its ease of access to disposable income. Therefore, the US companies help quench the thirst for consumption of goods and services by the vast population and the growing middle class. The US companies are also attracted to investing in China because of the relatively lower cost of production. The vast population provides a steady and relatively cheap source of labor to US companies. Moreover, the Chinese workforce is rather skilled when compared to other Asian countries. China has invested in training its human resources by setting up thousands of universities and higher education training facilities across the country. China has also invested a lot in infrastructural development and technology, making it an attractive destination for foreign investments. The US companies employ and offer services to millions of Chinese people. Furthermore, the US companies have enhanced the technological capabilities of China through the transfer of skills and technologies. By so doing, the US companies have made China a preeminent global leader in technology. For example, the US electric car manufacturing company, Tesla, is one of the most prominent investors in China. Tesla has invested over $2 billion in the battery manufacturing facility in Shanghai. The company has gained so much footing that China is now the leading producer of electric cars. Tesla has even diversified into other sectors. Likewise, in 2018, the US mobile manufacturing giant Apple has invested vast resources in China. In the recent past, Apple engaged a company called Foxconn to produce 220 million iPhones in China. The company has employed thousands of Chinese people, including non-skilled, skilled technicians, engineers, and managers, to work in its factories in China. Furthermore, the US companies have established thousands of local suppliers and distributors who also employ many other people. However, according to the American Chamber of Commerce in China, AmCham, several US companies face difficulties in their operations in China. AmCham argues that Chinese companies with similar functions to US companies get preferential treatment. AmCham believes that the playing field is biased towards Chinese companies because of how the Chinese market is structured. In particular, AmCham has argued that China has put restrictions on some specific industrial sectors, whereas the US does not place restrictions on Chinese companies. For example, China has capped the foreign investment in healthcare services to not more than 70%. China has limited foreign enterprises' investment in cloud computing to 50%. In the movie industry, China regulates the time of releasing new movies. Furthermore, it requires that 75% of the revenue generated by foreign films remains in China. Such a scenario is unheard of in the US, and the Chinese can release movies whenever they feel like it. The trade dispute between the US and China has raised the level of anxiety of US companies in China. The companies fear that the trade dispute can lead to a fallout between the two countries and jeopardize their investments. The coronavirus pandemic has disrupted the supply lines for US firms, further raising the level of anxiety. Pundits in the industry think that most companies will rethink their investment strategies in China and spread their risks instead of relying solely on China. A possible way of mitigating the risks is for the companies to extend their investment to other Asian countries. Data for 2013 showed that of all the manufactured goods that the US sourced from Asia, 67% were from China. However, by 2019 China's share of all manufactured goods from Asia bound to the US dropped to 56%. The drop is due to US companies shifting their operations to other Asian countries. The trade dispute has necessitated some US companies to announce intentions to shift part or all of their operations from China. There are indications that about 50 multinationals, including Dell, Nintendo, and Apple, have signaled their desire to relocate from China to avoid the punitive tariffs imposed by the US. According to Nikkei Asian Review, HP and Dell, which is a leading US personal computer maker, intends to shift up to 30% of their notebook manufacturing business out of China to Southeast Asia. Nikkei Asian Review has also reported that Apple has called its prominent suppliers of products to evaluate the cost implications of relocating 15 to 30% of their manufacturing capacity from China to India. China will significantly suffer losses if these companies proceed to transfer their operations to other countries. Nevertheless, it seems that the drawn-out trade dispute is taking a significant toll on China's economy. By the second quarter of 2019, the country's economic growth slumped to 6.2%, considered the lowest rate in the last 27 years. The global research and advisory firm Gartner reported that by 2023, about 30% of the leading supply chain companies have signaled to shift at least part of their production out of China. The companies cite the slump in sales, disruption in supply lines due to the coronavirus pandemic, and the increasing cost of production as the reason for moving out of China. The suppliers for Nike have relocated to Southeast Asia and Africa. For example, Foxconn, a leading supplier for Apple, is building a plant worth more than $1 billion in India due to its commitment to Apple's intention to move out of China. Furthermore, Apple intends to produce upwards of 30% of the classic AirPods in Vietnam and not China. The U.S. toymaker company Hasbro Inc. has indicated that it may reduce the number of goods produced in China by 50% because it wants to shift its production plants to India and Vietnam. China is likely to feel the pinch of the intended move of U.S. companies out of the country. The steady growth in the economy has already shown some signs of stress. Pundits expect the economic growth for China to slow down, which would have far-reaching impacts. A depressed economy will mean that many people will lose jobs, and unemployment will rise. Job losses are usually accompanied by loss of income among family members, which has many debilitating impacts on families. There will be less money to spend, which means fewer taxes for the government. A drop in tax will lead to depressed revenues for government expenditure and, therefore, less development. Data shows that the economies of Southeastern Asian countries are reaping big from the flow of investment by U.S. companies shifting out of China. For example, in the second quarter of 2019, Vietnam's economy peaked at 6.7%, far much higher than China's 6.2%. In particular, the manufacturing sector in Vietnam witnessed the most significant surge in requests for investment permits. In the first half of 2019, the application for foreign investment permits jumped up by 26% in Vietnam compared to the same time in 2018. Furthermore, China expects to lose a lot in terms of technology acquisition and development. The U.S. companies have stimulated the development of technology in the country to the extent that China is now a leading technological hub globally. Therefore, shifting operations away from China will mean a loss of technology and innovation and will negatively impact the economy. Furthermore, the stature and standing of China among the countries of the world will undoubtedly drop. In other words, China's clout among other nations of the world will take a beating.
To keep watching more cool facts, please subscribe to our channel now.